Welcome to another episode of IJS Speaks. Today's episode is titled, What Happens If? So today I wanted to talk about the topic du jour, which is the U.S. debt limit ceiling. And I understand that market expectations are for a decision or a compromise to be made at some point at or before the so-called X date. Well, today's podcast explores what happens if. So, what happens if there is no compromise? How does that play out, at least initially, within financial markets? So, what happens if we get to the Treasury's X date and no compromise has been made on raising the U.S. debt limit, or, in other words, the anarchists get their way? The most direct impact, I believe, would be felt in the bond market, as investors would be in a bit of a panic, rushing to move money out of fixed income. In this type of environment, cash and liquidity will be at a premium, and risk will be sold across the board to cover losses on bonds and other credit instruments. Now, falling bond prices will push up market interest rates, which in turn will put downward pressure on stocks, with the whole idea of discounting future cash flows. An unlikely scenario, but one worth considering, is that the historically inverse relationship between stocks and bonds, which underpin the 60-40 portfolio model, holds through the market disruption. In that scenario, a sharp sell-off in the fixed income space would result in a corresponding rally in the stock market as a function of portfolios being repriced and rebalanced. A more likely scenario is that the run-up in both stock and bond yields from falling prices could also mean precious metals become less attractive, as they do not have a carry yield, and therefore investors do not get paid to wait while holding those assets. And of course, there's also a reduction in demand for precious metals from an inflation hedging standpoint, as rising rates will signal less credit creation, which in turn means there's less upward pressure on inflation from consumption and investment spending. The implications for commodities markets would be similar to those of other risky asset classes. So, for instance, if U.S. demand for fuel is seen as waning, the price of oil will have justification to accelerate its current slide lower, which probably incites more production cuts from OPEC+. The asset class whose forecast is the most opaque is crypto, as the market reaction in this space will largely depend on how volatile the moves are among other risky assets. So, for example, if the broader market sell-off is orderly, the crypto space could indeed act as a safe haven for alternative liquidity. If, however, the market sell-off is violent and abrupt, the crypto space will experience the proverbial baby being thrown out with the bathwater, as investors flock to liquidity in the form of fiat currency. In which case, The most likely candidates to benefit would be currencies like the Swiss franc, the Japanese yen, and the US dollar, which all typically hold haven status in times of great market uncertainty. So, the run up to the X date can be expected to be filled with market volatility with a bias to the downside. With the level of uncertainty surrounding the risk that the US government would not make debt payments, investors will be rightfully shifting holdings away from market risk and towards liquidity. As the adage goes, America always does the right thing after doing everything else. So, if history informs expectations, then the failure to pass the TARP legislation on the first vote comes to mind. Political lines were drawn, and the interest of the American public became an afterthought. It wasn't until financial markets responded with a massive sell off that Congress saw the light and voted to authorize the bailouts. With this as prologue, it's easy to see why investors are shifting to overweight cash. The overwhelming expectation is that an adverse market reaction to Congress making the wrong decision at first would present opportunities to acquire premium assets at discount prices. This, of course, will be short lived, as Congress will subsequently make the right decision and asset prices will once again reprice to reflect a new reality. This has been another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. When in doubt, take profits.